You've likely heard names like Warren Buffett, the Oracle of Omaha, or maybe encountered really strong opinions about whether investing in real estate is always a slam dunk.
Uh-huh.
Or perhaps you've been told about the allure of picking the next big stock, the one that will make you rich overnight.
Right, the dream stock.
Exactly. But what if some of the most widely accepted truths about money and investing aren't quite what they seem? What if the financial world is, well, full of myths that actually hold us back?
That's a really interesting way to put it.
Today, we're embarking on a deep dive into your sources. We want to cut through that noise, challenge some of that deeply ingrained conventional wisdom, and reveal the evidence-backed insights that truly matter for your financial future.
Yeah, get past the headline.
It's really about getting to the core of what works, what doesn't, and most importantly, why helping you move from simply hearing about investing to hopefully truly understanding investing with some surprising clarity.
And we'll explore some fascinating data, connect ideas that maybe don't seem related at first glance, and hopefully reveal those aha moments that can profoundly shift how you approach your investments.
Yeah.
This isn't just about memorizing facts. It's about context, critical thinking, and really equipping you with practical wisdom for your own financial journey.
Okay, let's dive in. First up, the Buffett paradox.
Ah, yes.
So Warren Buffett, the Oracle of Omaha, legendary status, right? His investing prowess is just off the charts.
Undeniable.
When you look at his record since taking control of Berkshire Hathaway way back in 1965, the stock has returned an annualized 19.8% through the end of 2023.
19.8% annually for decades.
It's astonishing, nearly doubling the S&P 500's return over that same period. It's the kind of performance that makes you wonder if he possesses some secret sauce, some kind of magic touch.
And what's truly compelling here is how his sustained incredible outperformance for such a long time makes so many people question the whole idea of simple diversified index investing. If one person, one active manager, can beat the market for decades, why would you, the listener, settle for average, boring market returns with an index fund? It definitely challenges that notion that markets are super efficient and impossible to beat consistently.
And here's the truly fascinating twist, the paradox. This investing icon, who achieved these unparalleled active returns, is also maybe the loudest champion for simple, low-cost index investing for everyday people.
Yeah.
How do you square that circle? It feels contradictory, doesn't it?
It absolutely does on the surface. But, when you dig into his reasoning, it actually makes perfect sense. Despite his own active management success, Buffett has consistently, repeatedly, and very publicly advocated for index funds for most investors.
Like explicitly.
Oh, yeah. In his 1996 shareholder letter, for instance, he explicitly stated that most investors, both large institutions and individual savers, would find the best way to own common stocks is through a low-fee index fund. He even went so far as to say that this path would ensure they beat the net results after fees and expenses delivered by the great majority of investment professionals. He's consistently advised investing in S&P 500 index funds, emphasizing that message over and over again.
So how deep does his conviction for index funds truly run? Did he ever, put his money where his mouth is to prove this point, beyond just writing it in letters?
He didn't just talk the talk. He famously walked the walk, putting $1 million on the line to prove it.
$1 million.
Yep. In December 2007, Buffett famously bet Protégé Partners, an advisory firm skilled in manager selection, that they could not pick a collection of actively managed funds that would beat a low-cost S&P 500 index fund over a 10-year period.
Okay.
Protégé went all in, picking 5 funds of funds, which collectively held over 200 hedge funds. High fees, lots of supposed expertise. Buffett won that bet, easily. He detailed it in his 2017 letter, and the outcome perfectly illustrated his point. Investors, in aggregate, are simply not getting their money's worth when they pay high fees for investment management. Most are far better off with low-cost index funds.
That's a powerful demonstration. But what does this all mean for you, the individual investor listening right now? Does his advice extend to his own legacy?
Absolutely. He's so convinced that this simple index fund approach is superior for most people. He's instructed that after his death, 90% of the cash left for his wife's benefit should go into a very low-cost S&P 500 index fund.
90%.
9%. And the remaining 10% into short-term government bonds.
He truly believes this basic, low-cost strategy will yield superior long-term results compared to almost any active manager out there. He even reiterated this instruction recently. It's a definitive endorsement.
Wow. Okay, so why? Why does the master active manager say this? What's the underlying explanation? Well, if we zoom out and look at the bigger picture, Buffett himself acknowledges that active managers, including Berkshire Hathaway itself, eventually get too large to continue consistently outperforming the market.
Too big to succeed, basically.
Sort of, yeah.
Wow.
We call diminishing returns to scale. The larger an active manager's asset base gets, the harder it becomes for them to find enough compelling investment opportunities that can actually move the needle on such massive sums of capital.
Makes sense.
He doesn't even expect Berkshire to be able to beat the S&P 500 over the next decade. He said in 2020 he wouldn't bet his life on it.
Really?
Yeah. And he's also admitted that his best year, 1954, was when he was managing peanuts. It truly is harder to outperform with larger amounts of money.
That's a fascinating insight. And it's not just Buffett saying this, right? There's academic research on this.
Indeed. There's a highly cited 2004 academic paper that describes this phenomenon. They call it the efficient market for manager skill.
Okay, break that down.
The theory suggests that investors, quite rationally, identify skilled managers based on their past performance. Then they allocate more and more capital to those managers.
Right.
But this allocation continues only up to the point where the managers, because of the sheer size of their funds, can no longer beat the market after fees.
So they get flooded with money.
Exactly, the net result. The most skilled managers might end up running the largest funds, but their investors often simply earn market returns, maybe even slightly less after those higher active fees, compared to just holding a cheap index fund.
So the challenge for you, the listener, is finding these rare, truly good active managers before they get too big.
Precisely. If you wait until they're famous and everyone knows about them, it's often too late to capture any real benefit from their skill. The opportunity is gone.
It sounds like a tough game to win. And what about succession? When a legendary investor like Buffett eventually passes the torch?
That's another critical point. Even for the very best, picking future winning managers or having successors maintain that same edge is incredibly hard. Buffett is an anomaly, still going strong.
Yeah.
But he's brought in successors, Ted Weschler and Todd Combs. Brilliant guys, no doubt. But so far, they've actually trailed both Buffett himself and the broader market. It just goes to show that replicating that unique, intuitive skill is extremely difficult.
Okay, this is where it gets really interesting for your investing strategy. There was a 2018 paper, Buffett's Alpha, that offered another perspective. It suggested his incredible performance wasn't just unique stock-picking magic.
Right. It was more about his systematic exposure to known return premiums or factors combined with consistent use of leverage.
Factors.
Right.
Explain those a bit more. What are they?
Sure. Think of them as common drivers of returns identified by research. Things like market beta, how much a stock moves with the market, size favoring smaller companies, value favoring cheap stocks, momentum buying stocks that have been going up. Then there's betting against beta, which favors safer, less volatile stocks and quality favoring companies with strong balance sheets and consistent earnings.
So simply put, Buffett was intuitively doing what academics later identified. He liked cheap, safe, high-quality stocks.
Exactly. And he often used Berkshire's insurance float, the premiums collected before paying claims, as a form of low-cost leverage to boost those returns.
So the mind-blowing insight here isn't that Buffett isn't brilliant,
Not at all.
but that when academics account for these systematic preferences, his so-called alpha, that extra return beyond just the factor exposure becomes statistically insignificant.
Pretty much, yeah. It doesn't diminish his genius. It reveals a different kind of genius. He intuitively discovered and exploited factor investing decades before academia formalized it.
And the takeaway for us?
The actionable insight for you is that these factors are now known. They're accessible. You can implement them in a far more diversified and systematic way than even Buffett did early on, often through low-cost factor funds.
So you don't need to be the oracle yourself.
Exactly. You can apply the principles without needing the magic touch.
And it's worth noting, Berkshire's style changed, right? Early on, when returns were insane, he favored smaller firms.
That's right, which fits perfectly with that diminishing returns to scale idea. As his capital grew, he had to hunt bigger game, moving towards larger companies.
Okay, one last Buffett point. His huge cash pile at Berkshire. People see that and think, should I go to cash? Is the market about to crash? Is he timing the market?
It's a natural question when you see billions sitting idle. But Buffett addressed this directly. He clarified that for most investors with, let's say, smaller numbers, not hundreds of billions like Berkshire, It would make a lot of sense to invest in index funds rather than holding cash while waiting for investment opportunities.
So the cash is a Berkshire-specific tool.
Yes. He explained that cash pile provides Berkshire the flexibility to make massive, opportunistic moves during big downturns, like they did in 2008, 2009. It's a luxury most individuals don't have. His advice for you is definitely not to sit in cash waiting for the perfect moment. Stay invested. Got it. Okay, let's shift gears and dispel some broader investment myths. Active versus passive management.
The eternal debate.
We've heard Buffett's take, but we still constantly hear financial gurus promoting active management, claiming they can pick winners. It's a powerful promise.
Right.
Does the data back it up?
Well, you look at someone like Dave Ramsey, very popular, who pushes actively managed funds. He argues strong returns are more important than fees. Just pick funds that have outperformed the S&P. It's not rocket science.
Is it that simple? Does past performance predict future results?
That's the crucial question, and the answer overwhelmingly is no. Let's start with fees. William Sharpe, the Nobel laureate, laid out the arithmetic of active management.
Okay.
Mathematically, before costs, the average actively managed dollar must equal the average passively managed dollar. It's just the market.
Right, it has to balance out.
But after costs, fees, trading expenses, active management as a whole must underperform passive. It's a mathematical certainty over time. Fees are a guaranteed drag.
And Morningstar's research backs this up. Absolutely. Russell Kendall at Morningstar famously said, if there's anything you can take to the bank, it's that expense ratios help you make a better decision. Low-cost funds beat high-cost funds. Fees matter a lot.
And the idea of picking based on past performance, that persistence. What does the SESPIVA scorecard show?
It's eye-opening. SESPIVA tracks funds that rank in the top quartile, the top 25% over 5 years. Then they see how many stay in that top quartile for the next 5 years.
And the result?
It's tiny. Less than 1% manage to stay top tier consistently. Picking past winners is emphatically not a reliable way to pick future winners.
So it's mostly luck.
That's what the research suggests. Fama and French, in their 2010 paper on luck versus skill, found few funds produce benchmark-adjusted expected returns sufficient to cover their costs. Most apparent success. Just luck, like flipping coins.
But wait, when I look at fund data, it seems like a decent number do beat the market. What am I missing?
You're likely seeing the effect of survivorship bias.
Explain that.
Survivorship bias means that funds that do poorly often close down. They merge or liquidate. So they vanish from the databases.
Ah.
So when you look at the data years later, you're only seeing the survivors, which naturally makes the group look better than it really was.
So if you correct for that.
When you're correct for it and include all funds that started, the reality is stark. Nearly 90% of actively managed U.S. mutual funds failed to beat their benchmark over 15 years.
90%.
And maybe even more telling, only about 43% of U.S. funds even survive for that full 15 years. The odds are just overwhelmingly stacked against active management over the long term for most investors.
Okay, myth busted. What about market timing? It feels so smart, right? Avoid the crashes, jump in for the booms.
So tempting.
And some data does show correlations like high valuations sometimes predict lower future returns. Seems logical to try and time it.
It does seem logical, but practically it's extraordinarily difficult, maybe impossible, to do consistently well. Why? Because you have to be right twice. You have to correctly predict when to get out to avoid the downturn, and you have to correctly predict when to get back in to catch the recovery.
The getting back in part is tricky.
Very tricky. And missing just a few of the best days in the market can seriously damage your long-term returns. Missing only the 15 best days of the S&P 500 from 1926 to 2020 cut your annualized return by over 2%. That's huge over decades.
And Buffett's take on this?
He famously said, even if you knew what was going to happen in the economy, you still wouldn't necessarily know what was going to happen to the stock market.
Ding.
Meaning the market is forward-looking. It prices in expected news. Only unexpected news really moves prices significantly, and by definition, that's unpredictable. The market always feels uncertain.
Okay, but what about indicators? Like yield curve inversions forecasting recessions.
Good point. They do often forecast recessions. But Fama and French looked into this in 2019. They found no evidence that yield curve inversions can help investors avoid poor stock returns.
So trying to time based on that?
Is more likely to do you harm than good, because you miss out on the market's expected positive return while you're sitting on the sidelines. Daniel Kahneman, the Nobel laureate, said you just can't develop true expertise in predicting the market. It's not regular enough.
And John Bogle,
Vanguard's founder, Famously said after 50 years he didn't know anyone who could time the market successfully and consistently. Didn't even know anyone who knew anyone who could.
Okay, message received. Timing is probably futile. What about dollar cost averaging then? Investing a bit over time instead of all at once feels safer.
It definitely feels safer, and it's a great behavioral tool. It eases the anxiety of investing a lump sum right before a potential dip. You buy more shares when prices are low, fewer when high.
So it's good.
It's good for managing emotions and regret, which helps you stick to the plan, and that's valuable. But statistically, lump sum investing generally outperforms over time because stocks generally go up over time. They have a positive expected return. Delaying investment, which is what dollar cost averaging does, means you're just taking risk later. You have more cash sitting out of the market for longer.
So it's like having less invested overall for a while.
Exactly. It's roughly equivalent to having an asset allocation where maybe only 50–65% of your intended investment is actually in risky assets initially. So great behavioral crutch, helps people get invested, but not mathematically optimal for maximizing returns.
Gotcha. Okay, let's talk about the allure of picking individual stocks, finding the next Amazon or Tesla.
The holy grail for some.
We hear the success stories, and it's tempting. But what's the reality? What biases trip us up?
Oh, so many psychological traps.
Yeah.
Confirmation bias, crediting skill for luck, overconfidence, thinking we know more than we do, illusion of control, believing we influence random outcomes, endowment effect, overvaluing what we own.
Especially if it's stock in your own company.
Absolutely. That concentration risk combined with emotional attachment is dangerous.
And companies do fail, right? Catastrophic losses happen.
They absolutely do. Think Nortel, Enron, they disappear, taking share prices with them. Even within the broad Russell 3000 index, 40% of companies had a 70% or more permanent decline from their peak between 1980 and 2014.
40%, that's huge.
And here's the truly startling statistic. A 2019 study looked at over 61,000 global stocks from 1990 to 2018.
Okay.
It found that all the wealth created by the stock market above Treasury bills over that period was driven by just 1.3% of the stocks.
1.3%?
Yes, a tiny fraction accounted for all the gains. And the majority of firms, 61% of them, actually destroyed wealth. They had negative returns compared to safe T-bills.
So simply put,
You are far more likely to pick a loser than a winner, and that loser is highly likely to not only trail the index, but to have negative absolute returns. The odds are just overwhelmingly against successful individual stock picking for most people.
wow. Okay, if stock picking is tough, what about day trading? Making quick money in and out.
The data there is even more brutal, honestly. A 2023 paper estimated Taiwanese retail investors lost about 3.8% of their portfolio value per year due to day trading from 1995 to 2019.
Oh.
From the trading itself, commissions, taxes, bad market timing, and the winners. Another study found less than 1% of Taiwanese day traders reliably made positive returns after costs.
Less than 1%.
And among the most active traders, 97% lost money. The study found no evidence of learning. It looked more like gambling.
Why do people do it then if the odds are so bad?
It seems to be driven by behavioral factors. People chase attention-grabbing stocks, high volume, big news stories, extreme moves. They trade urgently, often losing to institutions. It looks a lot like gambling and sensation-seeking.
Okay, so day trading is out. What about options trading? Even more leverage, potentially bigger gains.
Options can be used for hedging, but the majority of retail activity in options markets looks a lot more like gambling.
And the losses.
Staggering. One paper estimated retail investors lost $2.1 billion trading options from late 2019 to mid-2021. Another found over 75% of options trades lose money, and over half of simulated options portfolios lose over 90% of their value.
It's like a lottery.
Pretty much. A few big winners get publicized, but the vast majority, the average retail trader, loses money, often a lot of it.
And it's not just bad bets, right? Costs are high.
Costs are huge and often hidden. Retail options traders face enormous bid-ask spreads, sometimes 10%, 20%, even almost 30% on certain contracts. That's a massive hurdle before you even start.
And people might not even understand the risks.
Often not fully. They might use simple strategies or overly complex ones without grasping the true risk-return trade-offs. Research suggests it's often driven by those gambling and sensation-seeking motives again.
So the verdict on retail options trading.
Trading options has generally been a disaster for retail investors. Avoid the temptation.
Okay, let's shift to rethinking asset classes. Housing. Everyone says it's the best investment.
It's a deeply held belief.
And that big study, the rate of return on everything, seemed to confirm it historically, right? Better returns than stocks, even globally.
It did find that, yes. From 1870 to 2015, global housing returned about 7.05% real versus 6.89% for equities with lower volatility.
Yeah,
Looks great on paper.
but there's always a but.
The huge but is that this aggregate return is for all of the houses in all 16 of the countries in the study. It's practically impossible for you as an individual to access that asset class level return.
Why not?
Real estate isn't easily divisible like stocks. It trades in huge unit values. You can't just buy a tiny slice of all the houses. Owning one or two properties means you're taking on massive idiosyncratic risk specific to that location, that property, that tenant.
And that specific risk can wipe out the expected return.
Easily, it can swamp the broader asset class return. Plus, a huge chunk of that historical return, maybe half, came from net rental income.
Ah, so if you live in the house.
You forego that rental income component entirely. The return really comes from being a landlord, which involves work, costs, and hassle, or paying hefty property management fees.
So comparing mortgage payments to rent is flawed.
Extremely flawed. A mortgage is just one part of the cost. You need to account for property taxes, maintenance, insurance, and the crucial opportunity cost of your down payment and equity.
The 5% rule tries to capture this.
Yeah, it's a rough guide. Maybe 1% for property tax, 1% for maintenance, which is often conservative, and maybe 3% for the cost of capital, what your equity could have earned elsewhere. It highlights those often ignored ownership costs.
What about tax benefits? Like in Canada, the principal residence exemption.
That's a significant benefit, yes. Capital gains are tax-free. But even then, the hurdle for renters is often behavioral discipline, actually saving and investing the difference in cash flow compared to owning. Mortgages force savings. Voluntary investing is easier to skip.
Makes sense. Beyond the money, what about happiness? Owning a home is supposed to make us happier, right?
That's the common assumption. But research suggests we overestimate the long-run life satisfaction gains from owning. We adapt quickly. The big house becomes the new normal, not a daily source of joy.
And it can add stress?
It can. Homeowners might spend less time on enjoyable activities due to maintenance. And research shows debt level is a bigger predictor of happiness than income. Big mortgages often mean high debt, which correlates with less happiness and more marital conflict.
Plus the keeping up with the Joneses effect.
Exactly. Homes are positional goods. Their appeal is relative to peers. This fuels a hedonic treadmill, buying bigger, fancier homes, taking on more debt, but not getting sustainably happier. Like luxury cars, more fun to think about than the daily reality of owning. Spending on experiences generally yields more lasting happiness than spending on things.
Interesting. Okay, what about bonds? Seen as the safe part of the portfolio, are they truly safe long-term?
Less risky short-term, yes. But over long horizons, say 20 or 30 years, bonds can actually be even riskier in real inflation-adjusted terms.
Riskier than stocks.
Potentially, yes, in terms of preserving purchasing power. Global bonds returned only about 1.9% real from 1900 to 2018 versus 5% for stocks. That 3% annual difference compounded over a century is massive.
And recent good bond returns were an anomaly.
Largely due to falling interest rates, yeah. That's unlikely to repeat to the same degree. The big risk for nominal bonds long-term is inflation. Bad bond returns often follow bad bond returns during high inflation periods. They erode your purchasing power.
So bonds aren't a perfect long-term inflation hedge. What about gold, the classic safe haven?
Buffett's analogy is perfect here. Gold is not a cash flow producing asset. You can fondle the gold, but it will not respond. It doesn't produce anything.
And as an inflation hedge.
Research shows it's pretty poor over typical investment horizons, maybe a few years. It only seems to work over centuries. There's no reliable historical relationship with unexpected inflation. And it's had huge negative real returns during some high inflation periods, like the early 80s.
And it doesn't always protect in crashes.
Nope. In 2008, stocks crashed, gold also fell, while high-quality government bonds went up. Gold is volatile and unreliable as a portfolio stabilizer.
Okay, so if bonds are icky long-term and gold is unreliable, what about commodities or Bitcoin for inflation?
Some commodities, like energy, have shown some correlation with inflation, but their extreme volatility makes them unsuitable as hedges for most. And they often have poor returns when inflation isn't high.
And Bitcoin, fixed supply sounds good.
Sounds good, but the data doesn't support it as an inflation hedge. While inflation surged recently, Bitcoin fell sharply. It acts more like a speculative, high-beta tech stock, not a safe haven. It crashed harder than stocks in March 2020.
So what is the best way to deal with inflation risk?
The best defense is a properly diversified portfolio with multiple independent sources of positive expected return. Think global stocks, maybe tilted towards factors like value and small cap value, diversified across countries and industries. This decreases the odds that everything fails at once.
Diversification again. Let's talk more about risk. We often think of it as just volatility.
Right, the short-term ups and downs. But for long-term investors like you, risk should really be measured as the probability of not meeting your future consumption goals. Will you have enough money when you need it?
And the risk of total loss for a diversified investor.
Very, very low. Assuming global capitalism doesn't completely collapse, it's highly unlikely all global markets go to zero simultaneously. Volatility is risk if you need the money soon, but over long horizons, down periods are usually followed by up periods, reducing the long-term risk of stocks.
Okay, but what kind of risk should we take? Compensated versus uncompensated?
Great question. Compensated risk is systemic risk, the market prices, in things like owning stocks, market risk, owning value stocks, value risk, owning small stocks, size risk. You expect a higher return for bearing this risk. It's sensible.
And uncompensated risk.
That's random risk that is not associated with a positive expected return. Think holding just one stock or betting heavily on one industry. This type of risk can be almost completely eliminated through diversification. Taking it doesn't reliably increase your expected return, it just increases your range of potential outcomes, including disastrous ones.
So diversification is key to eliminating that uncompensated risk. It's the only free lunch.
Pretty much. Geographic diversification helps smooth returns when the U.S. market struggles. Maybe international markets do well or vice versa. Your portfolio isn't tied to one country's fate.
And diversifying across factors.
Also crucial. Factors like market, size, value, profitability aren't perfectly correlated. A study looking at rolling 10-year periods found it was rare for multiple factors to be negative simultaneously. Diversifying across them reduces the role of luck and increases your odds of getting the expected returns over time.
Makes sense. What about leverage? Borrowing to invest to boost returns.
Conceptually simple, right? Borrow money, invest more, amplify gains. A 10% gain on the asset becomes a 20% gain on your capital, minus borrowing costs.
But the downside.
It amplifies losses just as much. A 10% loss becomes 20%. A 50% loss could wipe out your initial capital. Plus, you have borrowing costs and the risk of margin calls forcing you to sell at the worst time. It's a double-edged sword.
What about leveraged ETFs? They seem like an easy way to get leverage.
They aim to deliver multiples of daily returns, like 2x or 3x the S&P 500 for that day. But they reset their leverage at the end of the day.
What does that mean in practice?
It means in volatile markets, the daily rebalancing can cause time decay or negative exposure to variance. Your long-term return could be significantly different, often much worse, than just 2x or 3x the index return over that period. Plus, they have very high fees, generally not suitable for long-term holding.
Good to know. Okay, let's move to practical wisdom. Realistic expected returns. People throw around 10% for stocks.
Yeah, that 10% figure is largely based on recent, exceptional U.S. market history, boosted by rising valuations. It's probably not a realistic expectation going forward.
And we need to think in real terms, right? After inflation.
Absolutely. Nominal returns don't put food on the table. Real returns do. That 10.5% nominal return in the U.S. ending 1985 looked great, but 7% inflation ate most of it. The real return was much lower.
And the U.S. might not repeat its stellar performance.
It's unlikely. Those post-1950 returns had some luck and rising valuations baked in. High current valuations suggest lower, not higher, expected returns going forward compared to history.
So what's a more realistic global expectation?
Looking at global stocks from 1900 to 2023, including markets that failed, the average real return was about 5.2%. Reasonable future estimates might be closer to 4.6% real or maybe 7.2% nominal, assuming 2.5% inflation. And that's before fees.
That difference between 10% and 7% expected return is huge long-term.
Massive. Setting realistic expectations is crucial for planning.
And the average return rarely happens in a single year, right? Returns are lumpy.
Very lumpy. Since the 70s, for major markets, most years saw real returns either below 3% or above 10%. Years close to the average are actually uncommon. Expect volatility, extreme returns should be considered very normal year to year.
Okay. Financial literacy, how important is it?
Hugely important, yet widely lacking. About 2/3 globally are financially literate, maybe a third even in developed countries like Canada.
And being literate helps.
Definitely. It's one of the best investments that you can make. It correlates with higher wealth, better investment habits, avoiding costly debt, and fewer behavioral biases.
Hmm.
It might explain 30–40% of retirement wealth inequality.
So what is good financial advice then? It's not stock picking.
No, good advice ignores the terrible odds of picking winners. It focuses on 5 key areas. 1. Goal formation. Defining why you're investing, aligning money with a meaningful life, using ideas like the PERMA model, positive emotion, engagement, relationships, meaning, accomplishment, helping you figure out what truly makes you happy. 2. Asset allocation. Finding the right mix of stocks, bonds, etc., based on your personal risk tolerance, your ability to take risk, time horizon, job stability, and the return you need to hit your goals. 3. Insurance needs. Protecting your plan from life's curveballs like disability or premature death. 4. Product selection. After the plan is set, choosing appropriate low-cost products like index funds to implement it. Bad advice starts with the product, good advice ends with it. And 5. Tax awareness. Minimizing taxes legally throughout the process, which boosts your net returns.
And even if you know all this, biases get in the way. An advisor helps with that.
Yes, a good advisor helps you overcome the inside view, your own biases and emotions. They provide discipline, optimize trade-offs, simplify complexity, and save you time. They're a behavioral coach.
And firms like Vanguard estimate this coaching adds real value.
Yeah, Vanguard estimated around 3% per year, Morningstar around 2.34%, mainly from behavioral coaching, tax efficiency, and keeping you on track with a sensible plan. It can more than pay for the advisory fee by preventing costly mistakes.
Okay, final area. Nuances of financial goals. The FIRE movement loves the 4% rule for retirement withdrawal. How solid is that?
It originated from a 1994 study using 30 years of historical U.S. data, mostly a 50-50 stock-bond mix, but it has limitations today.
Especially for early retirees, longer time horizons.
Exactly. For someone retiring at 40, needing income for 55 years, the 4% rule falls apart. Success rates drop. You likely need a much higher stock exposure or a lower withdrawal rate. Over very long horizons, bonds' low real returns are a drag.
And it was based mostly on U.S. data.
Yes, and U.S. returns were exceptional. Research shows globally a sustainable rate might have been closer to 3.5%. Plus, that historical data has survivorship bias. It excludes failed markets.
And current valuations are high, bond yields low.
Right. That forecasts lower future returns than the historical average the 4% rule is based on.
Yeah.
Newer estimates using current conditions and longer time frames suggest a truly safe rate might be closer to 2.5% to 3% before fees.
That's a huge difference from 4%, and fees reduce it further.
Yes, a 1% fee might knock about 0.5% off your sustainable withdrawal rate. It really adds up.
But spending doesn't have to be fixed, right? Variable spending helps, or working part-time.
Absolutely. Flexible spending, trimming in bad markets, spending more in good, allows higher average withdrawals. And earning even some income in retirement, maybe doing work you love, acts like a large, safe asset, changing the whole picture. Plus, meaningful work boosts well-being via that PERMA model.
Last point. Money and happiness. We chase money for happiness, but there's a limit, a satiation point.
Research suggests so. For day-to-day happiness, the effect seems to plateau around 60–65K USD income in North America. More money beyond that doesn't seem to buy more daily joy.
But life satisfaction can increase further.
It can, maybe up to $500, as money provides more control and autonomy over your life. But the effect diminishes. Money is a tool to facilitate well-being, using the PERMA framework, positive emotion, engagement, relationships, meaning, accomplishment. But it's not the end goal itself.
And we often undervalue time.
Big time. We think earning more now buys future happiness, but we undervalue our present time. Trading money for time outsourcing chores, working less, can boost happiness. Active leisure, flow experiences, strong relationships, spending on experiences, giving to others, frequent small joys, these create lasting happiness more than just accumulating stuff. As Jonathan Haidt says, love and work are key ingredients connecting us to people and projects beyond ourselves. That's where deep satisfaction often lies.
So a lot to unpack there. We've peeled back layers on Buffett, active versus passive, market timing myths, stock picking realities, options, dangers, reevaluated housing, bonds, gold.
And the consistent theme across it all, the power of diversification, low costs, discipline, realistic expectations, and connecting your finances to what truly matters for your well-being. Taking compensated risk, avoiding uncompensated risk.
Right. Time in the market, not timing the market. Building enduring wealth, and maybe more importantly, a truly rich life.
Exactly.
So here's the final thought for you. If successful investing isn't about finding the next hot stock or perfectly timing market swings, but about consistent, diversified, low-cost strategies aligned with your goals and capacity for risk. What does that mean for how you measure financial success? And maybe more profoundly, how do you define your rich life? What actions might you take today that align with both sound financial wisdom and genuine lasting happiness?